Do you really think one decisive court order could reshape the destiny of every digital asset in the United States? That question has electrified the crypto world, and all eyes today are fixed on the dramatic face-off between the Securities and Exchange Commission and Ripple. Yes, you heard that right. We are talking about the swelling tide of legal uncertainty that has kept both crypto newcomers and market veterans on the edge of their seats. Legal experts, blockchain entrepreneurs, and everyday traders are all asking the same burning question. Will Judge Torres, presiding over this high-stakes battle, deliver a final ruling that could forever alter the way digital assets are defined by American law? In this story, we will dive headfirst into the unfolding drama of the Securities and Exchange Commission versus Ripple, unravel the harsh critiques and surprising alliances surrounding the case, and illustrate how this entire showdown might actually catapult cryptocurrency trading to unprecedented heights, or drag it into deeper regulatory duress. We will also explore an explosive new directive affecting Fannie Mae and Freddie Mac that could reshape the mortgage landscape, and we will shine a spotlight on the astonishing ascent of Bitcoin, recently surging to over $107,000. Intrigued? Stick around to find out precisely how these developments interlock, and why one unexpected legal twist could be a defining moment for the crypto market. First, let us rewind to the heart of the commotion. On Wednesday, the 25th of June of the year 2023, a swirl of speculation surfaced around the possibility that Judge Torres was on the verge of handing down her final and pivotal decision in the case between Ripple and the Securities and Exchange Commission. One prominent crypto analyst, John Squire, went as far as to proclaim that the legal status of digital assets could soon be redefined. He spoke passionately about how a single ruling might shift the entire regulatory framework in the United States. However, not everyone was so quick to jump on the doomsday or triumph bandwagon. Pro-crypto lawyer Bill Morgan stepped in to criticize Squire's remarks, suggesting that people have lost sight of what exactly the pending ruling entails. Morgan was clear. This is not about an all-purpose reclassification of cryptocurrencies across the board. Instead, it is about whether exceptionally rare circumstances justify a reduction in Ripple's penalty and the dissolution of an injunction placed against certain types of XRP sales. The two sides, Ripple and the Securities and Exchange Commission, have already hashed out a deal in principle where both parties would drop appeals, allowing a prior summary judgment from 2023 to stand firmly in place. In that earlier judgment, the court segmented XRP sales into different categories, a distinction that rocked the entire crypto community. Among the settlement conditions is the possibility of scaling back a penalty to $50 million and officially lifting any ban on specific institutional sales of XRP. But all this hinges on Judge Torres issuing what has been termed a favorable indicative ruling. Without that, the lawsuit could explode right back into cross appeals. You might be thinking, wait a second, how does a single nod or refusal from one judge carry so much consequence? Well, consider that some crypto enthusiasts have painted this legal quarrel as a decisive test for whether government regulators can clamp down on digital assets arbitrarily, or if the market has a chance to define its own boundaries under an adapted framework. Meanwhile, defenders of government oversight argue that strong official guidelines champion consumer protections and ward off sleazy or fraudulent deals. So, you have these two titans of thought clashing, the unstoppable innovation wave and the unwavering regulatory iron fist. And right now, the world is breathless, waiting to see which side emerges victorious. By the way, if you are enjoying the intensity of this unfolding narrative, consider giving a friendly nod by showing your support. It is always uplifting to see that these deep dives resonate with you. Your engagement not only helps shed light on pivotal stories like this one, but also encourages more people to join the conversation around crypto, regulation, and how these forces overlap. Now, the tension persists as the court edges closer to its long-awaited decision. Ripple's lawyers are determined to sway the court with a supplemental letter that fleshes out their case for vacating the injunction and lowering the penalty. They argue the circumstances are extraordinary enough to merit a second look. The Securities and Exchange Commission, seeing the potential for a narrower penalty and the dissolution of restrictions on XRP, has signaled a willingness to drop its own appeal on one condition: that the court grants the final motion favorably. Otherwise, the commission is prepared to fight tooth and nail, potentially reviving its own previously shelved appeal regarding the classification of programmatic sales. While these legal back and forths rage on, the XRP token itself has had a turbulent market narrative. On that same Wednesday, the 25th of June, XRP dipped by 0.26%, partially negating a narrower gain from the day before. It closed nearer to $2.1853 and fell short of matching the broader crypto market's 0.49% rise. The result? A sense that XRP holders might be in for an emotional roller coaster ride. At the same time, with the broader crypto market growing to nearly $3.25 trillion, people wonder if one green light from Judge Torres might mean a sensational surge in XRP's price. The dream for many investors is to break firmly above the $2.3389 threshold, which some analysts believe could open the door to retesting a high of $2.6553. Skeptics, however, are quick to point out that if the court rules less favorably, or if the Securities and Exchange Commission resumes its assault, XRP might begin sliding towards sub-$2 territory, possibly flirting with the $1.9299 region. The outcome could genuinely hinge on whether the settlement details can hold. Disagreements and appeals could do far more than hamper XRP. They could deliver a serious blow to the cryptosphere's morale, once again demonstrating that regulatory storms are far from over. But let us not overlook that the world keeps spinning beyond Ripple and the Commission. Bitcoin has had its share of fireworks lately. While XRP was stuck in limbo, Bitcoin forged ahead, continuing its rally for 3 consecutive sessions, and at one point crossing the heart-stopping threshold of $107,393. It is hard to underscore how colossal that number is without reflecting on the sheer scale of demand, excitement, and trust that many institutional and retail buyers currently place in the father of all cryptocurrencies. Why this upward momentum? On that same eventful Wednesday, another major storyline linked to crypto burst onto the scene, a newly minted directive from the Office of the United States Director of Federal Housing. In a surprising twist, Fannie Mae and Freddie Mac, two behemoths that underpin around 70% of the entire United States mortgage market, were told to craft proposals treating approved cryptocurrencies as assets for mortgage risk assessments, without forcing them to liquidate into dollars. Yes, you heard it correctly. Instead of making prospective homebuyers or mortgage issuers convert all their crypto holdings to fiat, the directive is nudging these giant enterprises to hold, or at least consider digital assets on par with more conventional reserves. If that does not send a message about shifting tides and institutional acceptance, what does? This directive has enormous implications, given that Fannie Mae and Freddie Mac collectively back about 40% of all securitized United States mortgages. We are talking about a mind-boggling $12.8 trillion in overall United States mortgage debt. The order was championed by William John Pulte, the United States Director of Federal Housing for the Federal Housing Finance Agency, who stated that the move harmonizes with a broader vision of establishing the country as a global hub for crypto innovation and acceptance. The irony is not lost on anyone here. While certain corners of government appear to be cracking down on digital assets, at the same time, a major arm of the United States mortgage infrastructure is actually warming up to them. It is a contradiction that underscores a broader question. Which path will the United States eventually choose? A nation that embraces digital assets wholeheartedly, or one that suffocates them through ongoing legal skirmishes? MicroStrategy Chairman Michael Saylor did not miss a beat in calling this moment a defining pivot for institutional acceptance of Bitcoin, while Ripple's chief legal officer, Stuart Alderoty, praised the news as a win for more than 55 million Americans who happen to hold crypto. That said, what draws the biggest wedge in the current conversation is the unstoppable flow of funds into Bitcoin-based exchange-traded funds, particularly in the United States. BlackRock's A-Shares Bitcoin Trust, often abbreviated as IBIT, has made relentless progress since it launched in January of the year 2024. Analysts' debit has elbowed its way onto the top 5 leaderboard in terms of both year-to-date and trailing 3-year inflows, a staggering feat for what is still considered a relative newcomer in the grand scheme of asset management. Between all the United States Bitcoin spot exchange-traded funds, the net inflow soared to $207.4 million in just a short window. And this record 6-month streak of net positive inflows has left a significant mark, surpassing $3,201 million so far in June alone, hot on the heels of $5,232.1 million in May, numbers that are impressive by any measure. Observers love to highlight a sense of timing. BlackRock's formal application for a Bitcoin exchange-traded fund landed almost exactly 2 years ago, and since that pivotal day, Bitcoin's value has reportedly climbed by over 234%. Bloomberg Intelligence's senior ETF analyst, Eric Balchunas, remarks that traditional asset managers might be realizing that digital gold could, in fact, unlock new revenue realms. In that sense, the swirl of regulatory friction does little to dampen institutional appetite. On the contrary, it seems to stoke the flames when behemoths like BlackRock step up with cutting-edge products aimed at bridging the gap between conventional Wall Street and the crypto frontier. But let us take a step back. Even though buckets of capital are flooding Bitcoin-based exchange-traded funds, and the mortgage sector is flirting with crypto integration, there are ample uncertainties looming on the horizon. The standoff between Ripple and the Securities and Exchange Commission is just one part of a larger mosaic. The next wave of market catalysts may include fresh legislative attempts in the United States Congress, perhaps further clarifying how tokens should be regulated, or imposing new compliance obligations on exchanges. In addition, ongoing tensions in the Middle East, particularly a precarious ceasefire between Iran and Israel, could ripple outward, injecting volatility into everything from commodities to digital assets. Trade tensions also remain a wild card, especially as the global economy tries to recalibrate after widespread disruptions. Lest we forget, while crypto has established a near cult-like following, it is by no means immune to the macroeconomic storms that swirl in traditional markets. If inflation data in the United States unexpectedly jumps, or if foreign trade disputes escalate, you can bet those developments will reverberate across crypto holdings, possibly overshadowing even the most exhilarating legal or regulatory breakthroughs. Still, market watchers remain glued to a pair of crucial near-term drivers. First, does Judge Torres definitively approve the settlement that would lift restrictions on XRP sales to institutional investors and reduce Ripple's penalty to $50 million? If she says yes, the core of the lawsuit deflates, leaving the prior summary judgment from the year 2023 in effect and, some argue, reinforcing a moderate approach to defining crypto tokens. If she balks and denies the motion, the next shoe to drop might be a full-blown cross-appeal by Ripple, resurrecting the Securities and Exchange Commission's original motivations for a broader crackdown. The second major driver, Bitcoin's unstoppable approach to an all-time peak of $111,917. Will the unstoppable inflows into Bitcoin, spot exchange-traded funds, supercharge that climb even further, perhaps to unimaginable new heights? Or will the sudden emergence of a detrimental regulation or an unforeseen global crisis puncture the rally? There are no easy answers, and that is precisely what draws in viewers, traders, and decision-makers by the thousands. By the way, if you found yourself riveted by this conversation and want to keep up with the dramatic twists on the horizon, consider tapping that subscribe button or following along for more. Markets can be volatile and legal developments shift rapidly, so it helps to stay in the loop for every new development. As for XRP diehards, the short-term price story seems to revolve around surpassing the crucial threshold of the 50-day exponential moving average, which some analysts interpret as a bullish green light. If that occurs and momentum can latch onto supportive fundamentals, like a favorable court decision, a push toward that enchanting $2.3389 mark is not out of the question. And if that milestone is toppled, the next aspirational target is around $2.6553, reminiscent of the fervor that echoed throughout the market in the earlier months. Yet not all is sunshine on the technical front. If bears reassert themselves, and that might happen if the court case flounders, or if an unexpected macro setback surfaces, XRP could sink below the 200-day exponential moving average, placing the $1.9299 region under threat. The fragile peace and arching optimism around the crypto space is entirely contingent on how quickly these issues get resolved. For many, this is not just a matter of a small price swing. It represents the psychological confidence in an industry that has thrived more than a decade under scrutiny, speculation, jubilation, and at times condemnation. Meanwhile, the whales and major holders remain watchful. Behind the scenes, you can bet that institutional players are strategizing, prepared to pounce if a quick legal victory opens the door for mainstream institutional involvement or if discount opportunities emerge in the wake of negative headlines. Either way, as each day passes, the tension escalates, and more casual observers are drawn into the debate. In the midst of it all, the United States real estate market has become an unlikely but significant focal point in the crypto adoption narrative. Those inside the field see a future where more buyers might leverage part of their crypto portfolios in a mortgage assessment, thereby bypassing the typical requirement of full liquidation prior to closing. If that becomes standard, it might create a pipeline for digital assets to move fluidly into the realm of real estate, effectively bridging two massive wealth-building avenues. As one might imagine, that prospect has ignited excitement in certain corners of the crypto community while fueling worry among conventional lenders who fear the volatility that digital assets bring. Let us not forget that broader global conditions can intrude at any moment. Political friction, monetary policy shifts, and even natural disasters can shape the pipeline of demand for digital assets. One might recall how quickly the community once pivoted from discussing regulation to focusing on global conflict or recessions. The fluidity of the market means that even the most robust bull rally can be derailed if the dominoes fall in the wrong order. Yet the flip side is also true. An optimistic court ruling, improved legislative clarity, and stable macro indicators can catapult tokens toward fantastic new ceilings. To wrap it all together, the question remains: does Ripple's legal gamble end with a triumphant victory that cements the difference between different classes of token sales, or does it lead to a complicated cross-appeal nightmare that raises the specter of tighter government oversight? The ripple effect, no pun intended, goes beyond a single token. If Judge Torres grants those crucial requests, lifting the limitations on institutional XRP sales and reducing the penalty to $50 million, then the partial synergy established by the 2023 ruling will stand, reinforcing a nuanced understanding of digital assets in the United States. That alone might renew investor confidence. On the other side, if the settlement unravels at the final hurdle, the entire industry might brace for renewed litigation waves. Imagine the Securities and Exchange Commission reasserting its claims and targeting more tokens on the same grounds. Suddenly, that sense of a precarious ceasefire between regulation and innovation breaks down. And let us not lose sight of Bitcoin. It is speeding toward uncharted territory, poised to either crush its $111,917 all-time record or falter if external shocks become too formidable. The continuous surge of capital into Bitcoin exchange-traded funds suggests an appetite that few could have predicted just several years ago. So, the stage is set. We have a judge in the limelight, legal teams piling on the arguments, more than 55 million American crypto holders glued to the updates, and mortgage giants now required by the United States Federal Housing Finance Agency to explore digital assets as a legitimate form of collateral. This evolving story has it all: high-risk legal drama, big money at stake, and a digital frontier pushing relentlessly against traditional boundaries. In many ways, it is a saga that mirrors the colossal transformations that the world of finance has undergone in living memory. Stay tuned, because whichever way this verdict swings, it is bound to leave an indelible mark on how cryptocurrencies are perceived, traded, and integrated into everyday financial life. The next big development could be right around the corner, and one timely piece of news or a single tweet from a key player might send markets soaring or reeling. For everyone embroiled in this dynamic labyrinth, the best we can do is watch carefully, weigh every piece of data, and brace for the turbulence that inevitably accompanies a technology holding such massive disruptive potential. That is our story for now, folks. One steeped in legal showdowns, unstoppable market forces, and bold institutional leaps toward the uncharted realm of digital finance. As always, keep your eyes and ears open for the next chapter in the never-ending Crypto Chronicle.